Hey guys, so today, as the title of this video suggests, I'll be delving into the field of investing. You see, investing can be quite exciting but daunting for beginners, and usually this is due to a lack of knowledge and perceived complexity, which drives a lack of confidence. However, I believe knowledge on how to invest is paramount to your financial health and your personal growth. So for anyone who's dabbled in investing, or even if you're a complete beginner, I've set out to make the ultimate beginners-friendly guide to investing, and this is based off of years of my personal experience with investing, as well as my personal research. I'll break down the basics to empower you with the knowledge to make a start at navigating this field, and stick around to the end as I'll share the strategies and techniques which some of the best investors of our time use to grow their wealth, which you can easily apply starting today. Okay, so what is investing? Now, investing is simply the process of buying assets that increase in value over time and provide returns. Investing is slightly different from savings in that your resources are put to work today with the intention of a payoff in the future. Now, investing can be explored in many different ways, each with their own unique pros and cons. And the investment opportunity these days are endless. I mean, you can invest in real estate, which is buying a property with the hopes of selling it in the future for a return or gaining some rental income from the property. You can invest by starting a business, so money up front to buy products with potential returns in the future. You can invest in stocks, bonds, commodities, the list goes on, and range from sports trading cards to fine art. But in this video, I'm going to focus on stocks or equity investing. So stocks are a great way to get your money working for you with a low barrier to entry, but huge long-term upsides. I'll expound later on exactly what stocks are, but for now, allow me a moment to go over the reasons as to why would people invest. All right, so why invest? So the first reason, and as most would answer, it's to grow wealth, right? So by investing money in assets which appreciate in value over time, you can potentially earn a higher rate than if you would just put the money in a bank account. Okay, so the next reason is to beat inflation, right? So inflation refers to the gradual increase in prices of goods and services over time. So as these prices increase, the purchasing power of your money decreases. So as a result, your savings will, decrease over time, and that's just purely due to the rate of inflation. However, by investing, you can seek to outpace the rate of inflation and potentially protect the value of your money and even increase the purchasing power over time. All right, the next reason is passive income. So investments in dividend-paying stocks or rental properties can provide a steady stream of income that can supplement regular income. Other reasons include money for retirement or saving for a down payment on a house. It's important to know that everyone has their why, and it's crucial that you identify your why before you get started on your investing journey, because this will keep you dedicated all the way throughout. So considerations before investing. So the first one is you should clear your high interest paying debts immediately. That should be the number one priority before you even start on your investing journey. So high paying debts such as credit card loans, payday loans, these all accumulate interest fees which are much higher than any returns that you can potentially get from any investment. Also, by clearing these debts, you can potentially have more money to invest on a monthly basis. So you'll be able to get to your financial goals much faster. Another important consideration for you to have before you start on your investing journey is an emergency fund, or what I like to call a rainy day fund. So life is unpredictable and we should always be prepared for the unexpected. So before investing, it's best practice to have a rainy day fund or emergency fund stashed away in a savings account. This is just to cover any unexpected events, so job losses, illness, any major home or car repairs you'll have to undertake. And effectively, we need this stash of money so that you don't then dip into your investments or deplete your savings. And it's usually recommended for you to have enough money to cover 3 to 6 months of living expense. All right, now that we've covered those items, let's jump straight ahead to the specifics of investing. So what are stocks? Stocks, also known as shares or equities, simply represent ownership in a company. All right, so when an individual buys a share of a company's stock, they effectively become a shareholder and have a claim on a portion of the company's assets and earnings. Now, the stock market refers to the broader market in which all stocks are sold. And a major segment of this market is within what are called stock exchanges. So stock exchanges are centralized marketplaces where stocks and other securities are traded on a day-to-day basis. You may have heard of the New York Stock Exchange or the London Stock Exchange or the Tokyo Stock Exchange. In fact, most major economies have their own stock exchanges, and typically people interchange this with the stock market. As stocks trade on exchanges, they're usually given tickers, which serve as their identifiers on these exchanges. Typically, for a company's stock to be traded on these marketplaces or exchanges, they have to go through what's called an initial public offering, or an IPO. Simply put, this just opens up the stock so that it can be sold to the general public. So this allows anyone like you and I to become equity owners in these companies through buying their stock. Now we have some basic understanding of what stocks are. A good question then is to ask, why do the prices of stocks go up and down? Like on a fundamental level, what causes this? So the stock prices, just like the prices of everything else, are based on supply and demand. So if there are more buyers than sellers, the stock price will typically rise. And if there are more sellers than buyers, the stock price will typically fall. Now, there are different factors which affect supply and demand. And the first reason is a company's performance. So a company's financial performance, including its earnings, its revenue, its profit margin, these all can impact the stock price, right? So if a company performs well, the stock price will increase as more buyers flock to buy the stock. However, if the company performs poorly, most likely the stock price will decrease as more sellers will then look to sell the stock. Now, the second broad reason are economic factors. So changes in interest rates, changes in inflation, increase or decrease in employment. These will all affect the stock price. Let's say, for example, interest rates were to rise, then that will make borrowing more expensive for companies. And this will then lead to a decrease in profitability for a company. And hence, this will decrease the stock price. Now, the last reason is general news and events. News and events can be both positive and negative. Either way, they'll have an impact. Let's say a company has announced a new partnership. This may lead to some investor optimism. You'll see buyers flock to go and buy the stock. However, conversely, let's say a company were to have a scandal. Then you'll have investors look to offload their stock and sell the stock, which will lead to a decrease in the stock price. Okay, so how do you make money from the stock market? So there are two main ways that you can make money from the stock market. So firstly, it's portfolio value increase, right? So the portfolio is just the overall holdings of the stocks that you have. Now, as the value of these stocks increase, to make money, you simply sell stocks which are in your portfolio for more than you bought the stocks. Okay, the next way to make money through the stock market are through dividends. Now, dividends are regular interval payments which the company makes to its shareholders from the profits that they've made. And this is just a way to incentivize shareholders to actually hold on to the stock or new investors to buy the stock. So now that we know about stocks, now that we know about the stock market, and now that we know about stock exchanges, let's take it one step further to stock market indices. Now, a stock market index, plural indices, is simply a measure of the performance of a group of stocks that represent a particular market or a particular sector of the market. And these are simply used to track the performance of the stock market as a whole or specific subsets of the market. Now, there are many different stock market indices around the world, actually, and these cover various countries, regions, industries. Now, some of the most well-known indices include the S&P 500, which represents the 500 largest publicly traded companies in the United States. There's the Dow Jones Industrial Average, which tracks the 30 most actively traded US companies. And there's the NASDAQ Composite Index, which tracks 3,000 companies listed on the NASDAQ Stock Exchange. Most of them are technology companies. Now, stock market indices are typically weighted based on market cap. Now, simply put, the larger companies have a greater impact on the index than the smaller companies do. And this means that fluctuations in the prices of the index are close in correspondence to that of the highest value stocks which make up the index. So again, the biggest companies have a greater influence to the price of the index, over all other companies in the index. Now, there are also indices which track niche-specific areas of the stock market, such as real estate or oil or even gas exploration. Now, usually investors use the stock market indices as a benchmark for evaluating the performance of their own portfolios and for making investment decisions. And usually when you hear investors say the market is up or down, they're simply referring to the broad market indices. Okay, so now that we know about stocks, now that we know about the stock market, now that we know about stock indices, we're going to take it one step further and we're going to now speak about funds. Stick with me, I promise this will all tie in later. So what is a fund? Well, a fund is a type of financial vehicle which pools money from multiple investors to invest in various assets. And these could be stocks, real estate, bonds, you name it. There's a fund for it. If there's an investment opportunity out there, I'm telling you, there's a fund for it. Now, there are two main types of funds available to most public stock investors. There are mutual funds and there are ETFs, or exchange traded funds. Now, a mutual fund provides individual investors with access to professionally managed portfolios of a diverse range of investments. And an ETF, or an exchange traded fund, is very similar to a mutual fund, but they're usually less actively managed and it's traded on a stock exchange like an individual stock is. So it can be bought and sold intraday, whereas a mutual fund, you can only purchase it at the end of the trading day. Then index funds are a type of mutual fund or ETF, and they simply seek to track the performance of a specific market index, such as the S&P 500. So when you invest in an index fund, you're then indirectly buying the shares of the underlying companies in that index that fund is designed to track. And this is because an index fund is a type of mutual fund or ETF that seeks to replicate the performance of the specific market index that it tracks. So for example, if you invest in an S&P 500 index fund, the index fund will invest in the 500 companies that make up the S&P 500 index, roughly in the same proportion as the index. That means when you buy shares in the index fund, you're effectively buying a slice of the portfolio. Now, while you're not directly buying the shares of the individual companies in the index, you're indirectly gaining exposure to them simply through your investment in the index fund. Now, this is important as it is a major step in allowing beginners to truly participate in the overall stock market. Okay, so now that we have that covered, let's swiftly move ahead to the actual strategies of stock investing. Now, there are two main strategies of investing. So there's active investing and there is passive investing. Now, active investing entails actively purchasing and selling stocks in order to outperform the overall market. As such, this type of investing is usually done by professional money managers or investment experts on the behalf of other investors. Now, on the contrary, passive investing is the investment in a diverse portfolio of assets that track a specific market index, such as the S&P 500. And rather than attempting to outperform the market, the whole aim is to obtain the returns that are comparable to the market itself. So this ties us back to index funds, which are very frequently used for passive investing, as they have a low cost and are structured to track specific indices. Now, take a guess of the strategy which the brightest and best at this investment game suggest for beginners. Well, it's not trying to make overnight millions by remortgaging your home to buy Tesla or Apple stock. No, it's through continual passive investing, allowing time and compounding to work its magic. There are well-renowned advocates for passive investing. Advocates such as John C. Bogle, who's the founder of Vanguard Group and the creator of the first index fund. Warren Buffett, the legendary investor who has consistently recommended low-cost index funds as a great investment option for the average investor. There's also Burton Malkiel, an economist and a famous author of the book A Random Walk Down Wall Street, which in that book he argues that passive investing through index funds is a more effective strategy than actively managed funds. A popular read and one of my favorite books is The Psychology of Money. The book also advocates for passive investing. I'll leave the link to this book and other useful books on passive investment in the description below. In fact, when it comes to active investing, this article published by the Financial Times stamps how difficult it is, even for the professionals. With less than 7% of the US active equity funds have been able to beat the market over the past decade. Now, to bring home this point, we can hear from the legend Warren Buffett himself on this investment strategy.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time.
So the market I would recommend for most beginners to look at is the S&P 500. Now, as mentioned before, the S&P 500 is composed of 500 large cap companies representing approximately 80% of the total US stock market cap. So it provides exposures to a broad range of companies across different sectors, and this reduces the risk associated with investing in a single company or a single sector. Also, the S&P 500 has traditionally delivered good long-term returns, averaging around 10% a year over the last several decades. And while there is no guarantee of future returns, the long track record has made it a popular pick for anyone hoping to build wealth over time. Also, when compared to the other indices, the S&P 500 is usually less volatile, which is a massive plus. You know, we don't want to see wild upswings or downswings. Steady, consistent growth is exactly what a new investor would need to see. So now that we understand stocks, the market, the funds, and the investing strategies, how do we actually take action? Well, the key is through dollar cost averaging. So dollar cost averaging is simply investing a fixed amount at regular intervals over time. This helps you to manage your risk and allows you to comfortably stick to your long-term investment plans. The key is to start as soon as possible and for as long as possible, regardless of market conditions. So, for example, let's suppose you decide to invest, let's say, $100 every month in an index fund over the next year. The index fund price is high 1 month, so you'd invest $100, but you've bought fewer shares, right? Just because it's more expensive. Conversely, if the index fund price is low the next month, you'd still invest $100, but you would end up buying more shares. So over time, this strategy can help you smooth out the overall cost of your investments. So think of dollar cost averaging just as you would a savings plan, all right? So just as you set aside a fixed amount of money each month for your savings, you do the same for your investments. So you set aside a fixed amount of money for your investments and you invest by using dollar cost averaging. Okay, so now that we know the strategies and the techniques for investing, we'll need to identify a broker for us to access the market. Now, there are many different brokers to choose from to start your investing journey. Personally, for me, I use Vanguard. I've just been using them for years. I favor the ease of their platform and their low fees. All right, now you'll need to set up an account. All right, so if you're in the UK, you'll look to open a stocks and shares ISA, or an individual savings account. Whereas if you're in the US, a Roth IRA or Roth individual retirement account is a great start. And the reason I've suggested a Roth IRA over a traditional IRA is with a Roth IRA, you can withdraw your contributions without any penalties if you really need to. So not earnings, so nothing above what you put in, but your initial contribution. So not that we would ever want to withdraw, well, hopefully not, but just the added flexibility is a plus. So both the ISA and the IRA are investment accounts with tax benefits. So it's best practice to max out these accounts first before you open any other general investment brokerage accounts. Now, I won't go into any details about how you actually set these accounts up. It should be fairly straightforward once you've selected your broker. Now, once your account is open, you can now buy shares of the S&P 500 index fund by placing a buy order. Now, to track the S&P 500 index fund, available for the UK is the S&P 500 UCITS ETF, or VUSA. For the US, the index fund to look for is the Vanguard 500 Index Fund, also known as VFAX, or the Vanguard S&P 500 ETF, also known as VOO. Now, as mentioned earlier with dollar cost averaging, I recommend that you set a monthly budget to automatically buy a fixed amount which you can comfortably afford and grow your portfolio over time. So this money just automatically goes straight from your income to your portfolio. Now, with that said, you should only invest a comfortable amount of money each month. Right? You should never invest money that you need to survive. You should never do that. No, investing is a marathon and not a sprint. And the goal is to keep your money invested for as long as possible. Now, you'll need to have a strong and dedicated mindset, alright? And this means investing in the good times and the bad times. So when the markets rise and when the markets fall, it's just important for you to remove your emotions from investing. And in the words of Warren Buffett, the stock market is designed to transfer money from the active to the patient. And an intelligent investor should always bear this in mind. For me, I usually like to set it and forget it, right? So you need to take the stance that the money which has been invested is for the long term and not the short term. So market fluctuations are meaningless on the grand scale of your outlook. So now that you know how to invest, allow me to set some expectations. Investing passively in the stock market won't make you a millionaire overnight, in a week, or for most of us, even 10 years, 20 years. Investing should be seen as long-term wealth building. Due to compounding, however, investing over time is a powerful tool to just do that. Alright, so simple example. Let's take the average investor who initially invests $1,000 in the S&P 500. And we'll assume the historical average rate of return of the S&P 500 at 10% per year, right? So with continued monthly investments of $100 per month for 5 years, they will have $9,382.02. Interesting, right? So, well, how do you get to $1 million? All right, cool. So, well, let's take the same investor. So at $1,000 invested up front and a monthly contribution of $100 and assume the same 10%, it would take 44 years to reach $1 million with total contributions of $53,800. Now, if you increase your monthly contributions, you're able to reduce the time it takes to have a portfolio valued at $1 million. Okay, well, let's take the same scenario and increase the monthly contributions to $5,000. It will actually take approximately 10 years to get to $1 million. And this is assuming perfect market conditions, which will give you a rate of return at 10% per year. So it's amazing to see how the increases in the contributions can drastically change your time to get to $1 million. I mean, it's also interesting to see how much time plays a vital role in actually growing your portfolio. So the longer you're able to keep your money invested, allowing interest on your returns from initial interest allows your portfolio to grow even faster. This can be summed up by a famous quote made from Albert Einstein. Compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. So let's just look at a few different scenarios again. So how long does it take to reach to $1 million? So to do so in 20 years, you need a monthly contribution of $1,500 a month. To do so in 10 years, you need monthly contributions of $5,300 a month. To do this in 5 years, you need monthly contributions of $14,000 a month. It's crazy. Alright, so as you see, investing is a long-term wealth building strategy, and it's definitely not a get-rich-quick scheme. However, as I said at the start of this video, starting on a committed investing journey as early as possible is paramount to your financial health. I truly believe that. And just before the end, I'd just like to leave you with some words of advice. Right, so it's all well for us to look into how we can gain passive income. However, we should definitely still have active income at the top of our consideration. And we can boost active income by learning relevant in-demand skills, high in-demand skills, or by starting a business. Always remember that time is actually equal to money. And investing is the same, right? So investing in stocks, investing in a business, or investing in yourself. And in closing, I truly hope that the topics that I've discussed in this video allows you to make a start on your investing journey very soon. Alright, and just a disclaimer, none of this is financial advice. It's purely based off of my personal experience and my personal research. Alright, again, thanks for your time and catch you in the next one, guys. Peace.